From the morning reading, expect light volume on Thursday. Markets are closed on Friday. The momentum is faltering. The S&P 500 is the latest index to end a long streak on momentum as it closed below its 50-day moving average for the first time in more than 100 trading days. But it also set a new all-time high during its streak, and half of the 10 major sectors are still trading above their own moving averages. When momentum has been that strong for that long, it has led to above-average returns after the streak ended. Concerns are rising. As the trend in stock shows some cracks, traders are pricing in a greater chance of a big move in the short term than the medium term. That has inverted the curve in VIX futures, even as the S&P 500 is still more than 5% above its long-term 200-day moving average. Every time this has happened before, the S&P was higher a month later. Short-term sentiment is getting pessimistic. The short-term optimism index is at its 40 or below for only the 11th time in the past year. All 10 of the other signals led to rallies in the S&P 500 over the next week, averaging 1.8%. It averaged a maximum loss of negative 0.7% at its worst point during the week, with only one of them being more than negative 1.5%. As always, we should watch for a change in character. If stocks sell off harder than this, that would be a caution signal that the solid trend from the past year can't be counted upon as much. The Dow and the S&P 500 are threatening their 50-day averages. Technology selling weakens the NASDAQ. Financials and transports continue to underperform. The VIX hits a 5-month high. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:37 a.m. Mountain Time, and I'm recording this in preparation for the market day of April the 13th, 2017. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and jump into the morning report. And at the time of this cut, we got a bit of weakness. In fact, the S&P futures are down almost 0.25%. Russell and NASDAQ and Dow futures are all down just below scratch. Crude oil is up about 0.25%. Euro's up about 0.33%. Long bonds are up about 0.6%. And gold continues its recent short-term bullishness. It's up almost 1%. China is just above scratch. Hong Kong just below scratch. Japan down about 0.2%. Germany down about 0.33%. And United Kingdom down about 0.5%. In terms of macroeconomic reports for today in the United States of note, you have PPI, the weekly unemployment claims, the University of Michigan Consumer Sentiment reports, and the nat gas storage. Got a number of bank holidays overseas, and then, of course, our own bank holiday tomorrow. Markets will be, regular markets will be, cash markets will be closed tomorrow with Good Friday. In terms of current volatility conditions, things have been cooking up. Short-term VIX up to a 10.91. Skew still elevated, currently coming in at a 131.93. IV percentiles are well up from their many times single-digit numbers of late. The S&P at a 33, the Russell 47, the NASDAQ a 39, the Dow at a 28. We have been 2 solid weeks without a standard deviation size move on the S&P 500, and we did, though, have another negative 1 standard deviation size move on the Russell yesterday. So that's been the market that's had a bit more movement. We've had 3 negative 1 standard deviation moves in the last rolling 2 weeks of trading action on the Russell, while at the same time in the other 3 markets being almost totally quiet. In terms of, let's go to the charts. So on our S&P, After the huge run-up post-election and setting multiple new highs, we've had a series now of lower highs and lower lows. We broke from that downturn channel and then promptly reversed that false breakout and have basically drifted in a sideways motion ever since. We are now into the cloud, which gives us an intermediate term market posture of a neutral kind of stance. In the very, very short term, the thing I would note is that with yesterday's action, it was the lowest close in recent action. So once we bounced off this lower part of the channel, big reversal candle, went all the way up, broke through the top of the channel, but ever since that action on 330, it has been essentially one negative close after another, with yesterday's not being the lowest price action, but yesterday being the lowest close since the reversal day on this, actually it was 327 trading day. So things aren't looking terribly good for the bulls, and yet at the same time you have to say they haven't given it up yet either. So things continue to look like they're deteriorating, and yet a very, very slow, gradual kind of deterioration process. And certainly there's not a lot of control by the bears as of yet. On the Dow, very much the same action. You're also neutral in the cloud. Lots of sideways action in recent weeks even. Really, we could go back about 3 weeks of trading action that are essentially all within a sideways box. NASDAQ has lost its very sharp wedge action that's been moving to the upside. It broke down from that wedge a couple sessions ago and confirmed outside of that just yesterday. Still above the cloud. It's clearly the most bullish of the four indices at this point, but is in danger of falling down to the cloud and falling down below these recent lows. It has not yet done that, but certainly seems to be heading that way. One of the morning authors mentioned about how technology selling has weakened the NASDAQ, and certainly that's a big part of that action. And of course, the Russell's actually been below the cloud and has had this slow motion drift to the downside. You notice we've had a number of lower highs. We could perhaps define this as a series of 4 lower highs, and now lower lows, though this most recent low was a little bit of a higher low. So something of an symmetrical triangle forming here. The pattern coming into the triangle looked to be a bit of a break from the prior bullishness, and then something of a bearish kind of action. Though we need to back up, and you notice I just backed out on the chart. And if you look back all the way back to the beginning of December, we really have been in just a sideways action for multiple months now. So we don't want to make too much of this micro kind of charting, when in the big picture, this is just sideways action that goes back for several months. A little bit of a head poke up here, a little bit of a poke down here, but we're still pretty much in a neutral posture until we break out of this big sideways band that you have on the Russell. In other markets, crude oil short-term action has been very bullish. And you see we've moved all the way from these lows up into the cloud. Haven't really had a cloud breakout yet, but still quite a bit of short-term bullishness in the crude oil market. Has not taken out also the recent highs. We had multiple touches of this area. So quite a bit of resistance just above where we are in the crude oil markets at this time. In other markets, gold has also been on something of a bullish tear of late, and especially in the last couple trading sessions. We clearly have broken out finally above what was an area of resistance in this area here, around 1266. big breakout 2 sessions ago and follow through on yesterday, would seem that we are going to head for this swing high in the 1300, 1306 area. Likely target there, certainly a place to be taking profits, as you'll likely find some selling once you get into that area. So where is gold in the big picture? Wow, this has been one of the most difficult charts for me to analyze in recent months. Just when you think things are safe and good and bullish, you get these big overshoots to the downside, then new highs, and then a clear breakdown, and it looks like we're putting into an intermediate term bearish. And then just when you think things are intermediate term bearish, you get a break and a series of higher highs and higher lows. And yet within the context of things, we're still, nowhere near as high as previously. So let's take a look a little bit larger time frame. Sometimes it helps if you go to larger time frames to see things better. And here is weekly candles on a 2-year. And I was just looking to see if we happen to have a head and shoulders pattern setting up. Not the cleanest one by any means. So I'm not really sure that gives us anything to really get excited about there. I guess we'll just leave it as it is. We'll go with the short term is bullish. The intermediate term is bullish. The long term, probably neutral. And we'll leave it at that for the gold market. In terms of bonds, bonds have had a recent cloud breakout and have come in and put in a, we'll call it similar high on recent tops. So probably in an important inflection point. If bonds are going to break up and start setting up higher highs and higher lows in the short to intermediate term, that would be quite a reversal off of the recent action. Now, you could certainly look at this as, bottoming action through here, kind of an end of trend, and then a flushing at off of an end of trend warning area here, and could be setting up for a reversal pattern. If that does happen, if bonds start to break up, we probably will see some corrective action in the equity market. So this could be seen as something of a warning sign for equities. And the same thing with the dollar. The dollar continues to have, it's kind of funny, Trump was talking about the dollar being too strong. Well, the recent short to intermediate term action's actually been weaker for the dollar. We've had a series of lower highs and lower lows. We're below the cloud. His comment would have been far more appropriate, frankly, in early December, mid-December, than it is here some 4 months later. But who knows what time frame he's speaking about. Okay, that's probably enough in the charts. Let's go ahead and go to the daily report. And as you would expect, we continue to see more signs of weakening of important indicators and postures and market timing elements, while at the same time, certainly not a breakdown by any means. We still have this kind of weak market phase 5. We have had this break of diagonal and horizontal support, especially on the big one, the S&P 500. And yet at the same time, it's not led to any, significant breakdown as of this point. In terms of the 3 market timing signals, we have a number of warnings here in the shorter to intermediate terms, but certainly not a consensus yet as to a bigger breakdown. The first market timing signal coming to us from Investors Business Daily, IBD, uptrend under pressure. So that's in caution status. GMI index, certainly a weaker score than we have seen most of the time lately, a 3 out of 6, and on the more sensitive GMI2, a 4 out of 8, but it's still holding on to that buy signal, which has been in place since 11:10. And then on the third market timing signal from Stock Charts Decision Point Scoreboard, we see the short term is quite mixed to slightly bearish. Yet the intermediate and long terms continue to hold on to their signals. Since we're primarily intermediate term traders and investors here, our focus here would lead us to have a consensus to the bullish side, but certainly we're recognizing that there are some shorter term signals that are starting to deteriorate. Position sizing model on the portfolio investor is currently at 50%, and on the active trader model is currently at 100%. In terms of the intermediate term market posture, we are in strong bear for the S&P, and actually this one should be in black. Weak bull for the Dow, and then weak bear for the NASDAQ, and then weak bull for the Russell. So we've got two that are in weak bull, and then perhaps the two markets that many people follow the strongest, the S&P, the most important one, and then the NASDAQ, in various bearish intermediate term stages. This is supported by a neutral sentiment line, so it doesn't really give us any expectation for an expectation of big bear or bullish moves at this time. And hedge warning status continues to be level 1 plus, a cautionary light as the way we describe that. So while this certainly is not high risk, that would be a 2 or a 3, we certainly have deteriorated over recent weeks into a situation where the likelihood that we go into a level 2 is increased, and we're certainly paying much closer attention than we do when we're in a level 0 or 0 plus. In terms of the 3 strategy opinions, VIX is in the acceptable threshold to initiate new positions. In fact, current VIX has been running around a 15. And I'm looking to see, actually we were up over 16 at this moment, so things are starting to climb. So that should be something to start to watch. Normal bull market VIXs we typically think of as 12 to 15, and as we get above 15, we want to start to watch to see if we're starting to accelerate towards above 18. So as it is right now, we're still within that acceptable threshold to trade. But we're probably starting to get a little bit more cautionary to the upside there. Cover calls and put selling for novice traders, generally not acceptable conditions in a level 1 plus to be initiating new positions until we see something of a bottoming in this shorter term price action. In terms of areas of specific concern under the volatility area, we've had a VIX daily squeeze fire. And we certainly have had an expansion of volatility in the recent sessions. The current distribution day count is elevated on both the NASDAQ and the S&P. Skew remains elevated. Under trend-based, we still have a number of weak warnings to stronger warnings. This market phase 5 is still relatively weak, though the intermediate term market posture for the S&P is now strong bear. In the intermarket risk aversion indicators, we've got 4 as risk off, and the last one is in danger of rolling over. So that certainly is an area of concern. In the fear and greed index from a sentiment bucket, we have this now dropping down to a 28, and it's in danger of falling into the extreme fear area for sentiment. So be aware of that. Recent price action in terms of sector specific has been definitely defensive. Utilities, telecom, consumer staples are your best performers with near universal breadth to the positive side, whereas the risk-on sectors have been the biggest losers. You see industrials, materials, financials all at 1 or greater percent losses in recent price action. In terms of sector-specific market postures, you see the ones that are holding up the best. Again, telecom, consumer staples, utilities. No accident to see these across all 3 time frames is holding up the best. The market is showing some signs of wear and tear, and these defensive sectors are the ones that are holding up. If you look at the last 3-month performance, last 1-month performance, An awful lot of red starting to show up across the multiple time frames at this point. Though 3-month performance is still relatively strong for most sectors, the last 1 month certainly has not been. Real exceptions, again, consumer staples and utilities, definitely the heroes in their consistency and holding up in the face of recent deteriorating conditions. Okay, I think that's probably enough for today. Let's go ahead and get to the disclaimers and get this published. We're almost 7 o'clock, so we only got half an hour before the market opens. Disclaimers, as always, hit the pause button before if you need more time to read this. Also note the hyperlink down here at the bottom of the slide that'll take you to the full set of disclosures. Manage that risk profile each and every day, and you'll get the consistency that you're looking for. In the meantime, good trading.